it's one where adding earnings in creates a little more variability, a little more volatility, but overall it has added more gains than losses in a significant way. And so we do have we do have this set up for, for earnings to be included when it comes to the challenge. All right, but option prices can get a little pricey, right? There's a little extra option risk and all those other things. So definitely have to do it right and make sure we're going about it correctly. So let's go with GM. And, here we'll have our 14 to 20 day basket. So we can go with our regular May monthlies, and we'll go with the 40 strike. And they're going for $1.14, $1.15 right here. Stock is at 40, option $1.15 here with it. And we'll exclude the earnings plays. Entry price of the stock, $40 and $1.15 on the option here. So if we do 7 contracts there with that, we'll be good to go. And these are once again the 40s, the 17th of May 40 calls. So 17th of May 40 calls. Okay, and today is 4:29 a.m. All right. Now the average true range here on GM is let's pull it up here. It's down here at pretty low level, 63 cents. I mean, that is very low here, especially for GM historically. So very small ATR there. It is something where, yes, that will affect, how the stock, plays out and everything else, or how the option plays out with how the stock moves on earnings. But we'll get a good chance to kind of comb through that. Sorry about that. I still have Netflix there. There we go with Baba. And then we'll scroll on down. We'll pop GM in here. And we are good to go. All right. So trade exit date would be 3 days from now. So we'd be talking about the 2nd of May. So 5/2 in the AM would be the trade exit date there. The auto date for the exit. So let me relabel that to be what it is on the top category here. Auto exit date. There we go. And I'll relabel this one here as well. And there we go. All right. Cash in. All right. So we did 7 contracts. So 805 cash in is what we are there with. And you'll notice I'm not doing it in the above basket. Right. This is just because earnings are here tomorrow morning. It just goes in this basket. Now, we're also going to come into this lower basket here. We're going to go do GM. Same date, 4:29 a.m. But we're going to choose a little bit of a different option here. Okay, we're going to come down to the July monthly, 53 days out. And we're just going to do the first, kind of this at-the-money strike, $1.50 for the 40s, right? $1.50 for the 40s there. So trade entry price $1.50. So we need to do what? 1, 2, 3, 4, 5, 6. Let's 6. Yeah, 6 would get us into the right area, right? So we'll go with that. And the entry price on the stock, $40. And these are now the June monthlies, right? So they are the 21st of June. 21st of June, 40 calls. And there we go, $1.50. ATR is the same, 0.63. So we'll get our stock exit, and exit levels are the same. And then we'll come in here and let's get this right here. There we go. And then we'll come down here to GM. All right, and the auto exit date is going to be the same as up here. Trade exit date, not there yet. Cash in. We're a little bit over. we're a little bit over the 800, but if we do one fewer, let's go do one fewer here. Get it to the 750. That's closer to 800 there. So we'll do the 5 here at it. So there we are. There we are into GM on the bullish signal here this morning, and running here with it. Now GM gapped up on Friday because of Ford's earnings, right? And so we had a nice little kind of gap up. You can see the 3-7 crossover that's coming into it here today. Bullish 3-7 crossover. You can see the stock is trading above 50 on the stochastics 39.1. I mentioned very rarely will we get put signals when we're above this area. It'll be mostly calls above this area, mostly puts below that area. So anyway, GM is in and on the table here. Now, I thought, I mentioned on Friday we could get a renewed bull signal here in Alibaba if we see some sort of move higher in it. We haven't seen that. We haven't seen that come in here just yet with Alibaba. There were a lot of stocks last week that really had some sharp moves lower, where they went below 50. They went from above 50 to below 50 on the 39.1, but they didn't trigger because just the magnitude of change did not suggest that, hey, chances are really good that they continue to fall and that it's a really good option setup. And a lot of these we're starting to see bounce back. Altria starting to bounce back. We're seeing Caterpillar bounce back a little bit. And so these are in positions where if they were to kind of push that next leg off of a lower high and start to push that next leg lower, they could easily trigger. But most likely they won't be triggering. Here today. As far as kind of the market open goes this morning, take a look at small caps. To me, this is the kind of this has been the laggard. We see a lot of calls for market to pull back and the market to sell off. We see other calls saying, hey, the market's about to rip higher and everything else. But while we've seen small caps lag the S&P, and we've seen them lag the S&P in a big way, and for some time now, overall, we are seeing small caps holding up. They're not breaking on down. They are holding up, and today, they're pushing into a new short-term high. We have this kind of little mini breakout trying to happen in it this morning. Now, it's still early, but that element is coming in. We see it kind of being led here by some of the financials as bonds pull back a little bit. As we see the yield curve steepen, you can see the financials the last 2 days, lagging, not really moving up with the market, lagging. Last 2 days, boom, boom, off they go. Right? And that kind of has the IWM pushing on higher, pushing on up in a little mini breakout mode. But you can see the SPY just carrying on, 4 points a day, 3 points a day on average over the course of a month. And it stacks up. It adds up. And, it continues to do so here with the SPY as it goes and hits new highs here. We do see the Dow performing a little bit differently, but, due to earnings, and one earner on the Dow is going to affect things to a much greater degree than it will on the S&P because there are only 30 stocks. But we continue to see tech hold up, and we saw tech try to sell off on Friday. Really, just kind of snapped on back. Tried to sell off on Intel, and yes, Intel had reason to sell off, but the other tech names really did not. And so we continue to see Intel go lower here. I would not be surprised to see Intel go a lot lower over the course of the next 2 months here. But I want to show you a chart, and let's clear this of all indicators. And this is the number of stocks setting new highs versus the number of stocks setting new lows. And in and of itself, okay, you know what? We have more new highs being set right now than new lows. And that has been the case the entire year. Right here, here's the zero line. We have had more new highs the entire year than new lows. Nothing too special about that. Nothing too amazing about that. If you look at the number of stocks that made new lows on the last dip, that came down and hit quite an extreme. But if we back this chart out, and we come out to 3 years, and we start to take a look at this, compare this to other bull markets. 2016 bull market, where everything was flat, many more new highs than new lows. 2017, many more new highs than new lows. End of 2017, many more new highs than new lows. 2018, here we are, ahead of the sell-off. Well, I guess the sell-off was right back here, but we get the bounce back to new highs. We're about at the same level we are right now. One thing this market is not experiencing is a participation rate that it has seen over the course of this bull market, where the number of new highs is outweighing the number of new lows in a big way. Here you can see 2012, right? 2013, 2014, many more new highs than new lows. Haven't experienced that. Markets hitting new highs. Tech's hitting new highs. But the participation rate is one of the lowest that we have ever seen. You say, well, what's it matter? Well, nothing in terms of what's going to happen today and tomorrow and what's going to happen the next day. But it's another one of those precursors here that says what? That says if there's a breakdown, it's going to be pretty big. So for the bears out there, what's it say? It says, chill, easy go, right? There'll be time, right? There will be time to react to a sell-off. It won't be a one-day event. It won't be a 2-day event. Most likely won't even be a 1-week event, right? For the bulls, you go, okay, yeah, sell-off's probably not going to be a 1-day, 2-day event, so you keep on going until something changes. But this stock in terms of participation rate, new highs versus new lows, just one of the lowest we've seen. And it's a warning sign. It's one of those that during the course of my trading career has always kind of, we see it happen. We see it come into play. But it's not necessarily, it's not a day trading type of thing. It's not a short-term type of thing. But, you take a look at the bull market since 2009, right here, right? Since 2009, this is the least participated in rally that we have seen. It only rivals what we saw in the rally last April and May of last year. That's its only rival. Now, things could keep on going higher, and we could see this move into healthy areas, right? We could see that come into play. Looking at where a lot of stocks are, it's going to be very tough. You need a lot of rebound in a lot of names because a lot of names are much closer to their lows than to their highs. FedEx's of the world, the Halliburtons of the world, a lot of those types of stocks out there. But what does this say? It says, look, this looks like a late cycle bull market. Has a runaway feel to it, Teflon feel to it, last in type of feel to it. And this is like small cap lagging. It's another one of those metrics that's a warning sign, but it's not a confirmation type of sign there with it. So, something worth keeping an eye on. I do think if we start to see, this move below zero, look out below. We're going to see some pretty hefty sell. But as long as it's above zero, it's one where top picking the market just is still going to be a frustrating endeavor. We talked about that on Friday. Top picking the market and whether it's right here right now is the time to look to do that. But it is one where I wanted to kind of show this. It's one of those metrics I look at every weekend. Right, I don't look at it on a daily basis, but every weekend I take a look at it. And we just kind of continue to see the same thing. happening here with it. Now, if we come into and we just look at this with the Nasdaq, you say, well, the Nasdaq's leading the way, right? So let's go look at the Nasdaq. We'll take a look at the Nasdaq. Look at the participation, number of new highs versus new lows. It's nothing like last year, 2017, 2016, 2014, 2015. Nothing like 2010. It's the lowest it's been on any new high rally. The participation isn't there. It's very specific. It's very individual names, driving, the indexes here. And it's not the type of mass participation that you see, or like what we saw in 2009 and 2010, or even here in 2013, where we just saw this mass participation rate in terms of equities. It's a very low participation rate. And it's one of the lowest that we've seen in a long time. And it's coming off of the heels of one of the biggest spikes in number of stocks hitting new lows that we have seen in quite some time. All right. So wanted to kind of show those here this morning. Also want to go out and take a look at Disney. Was asked about Disney this weekend. Blew the cover off the ball, box office, everything else, right? $1.2 billion opening weekend, just monster number, breaking all the records. I believe just in opening day, Infinity War made more than Toy Story 3 did during the entire life cycle of the movie. So just an absolute monster. This is one where after the earnings, right here, I mentioned that afternoon, that I had taken the majority of my long-term position off. I've had a long-term position since below $30 on Disney. And I took off the gain. I took off the $100 gain. It's been a long time, many, many years. Taxman will be calling, but took it off. Still have the cost basis, right? Just all the gains are gone. They've been taken. I'm not really interested in getting back in anytime soon. I mentioned it on this day. Not because I don't like Disney, but I'm just not wanting to kind of put in a long-term position on a chase. I'd rather build it on a drop. And Disney is chased on higher. It's chased on higher. Nice. Good. Is this a good news top for it? We're starting to get into some stretched valuations for Disney. We're starting to get into an area where, all the good news, is it priced in? Yeah, in a big way. Seeing the reversal this morning, early on the kind of blowout news, not a big surprise. If you're a major fund manager, been holding this a long time, this is something where you go, okay, what's the next catalyst for Disney? Oh, there isn't a great one right away. We've now had the two big catalysts, and the upside catalysts are gone for now. Doesn't mean it can't go higher. Doesn't mean it can't go to 160 or 180 or anything like that. But it is something that, all right, a little cool down period, a little bit of consolidation, for 6 to 8 to 12 weeks is something that for me personally I'm looking for. Now, for the challenge, does it need that? No, it doesn't. It just needs a signal and go. But, Disney, it's one of those where I don't think this is news that's buyable. I don't think you go, oh, man, they made all this money over the weekend. Let's go buy it. That news, it's been known. Infinity War, it's been known that it's coming out. It's been known that it's going to happen. Investors who wanted to try to take advantage of Infinity War, they're in. And, some of them are getting on out today. I don't know that we'll see a massive sell-off or, that it's very shortable here. But, we do see a little bit of selling the news type of action here with Disney. We have one famous investor, hedge fund manager, out this weekend. talking about this phenomenon of sell the news. And this is a fund manager who has been right on many calls, many upside and many downside calls in the market, and big types of things. And he came out basically saying the upside in the market is kind of gone right now. That there's very limited upside, and talking about any kind of sort of shock would drive the market lower. Now, he doesn't believe the market's going to crumble or anything. He says central banks are going to step in, and they'll step in on any kind of 15, 20, 25% sell off and rescue the market on those occasions. But he kind of used this U.S. China trade war as, hey, when the final news of that comes out, when the final deal is reached, that will actually be a sell catalyst for the market, which is kind of where I stand and what I agree with. But what's been really interesting about the trade talk and the trade deal, they've done a really good job of not finalizing it, of not making it a, hey, this is set, stone, done. They've done a real good job of, hey, this is just ongoing and ongoing and ongoing. And yeah, there are some deadlines here and there, but they have kind of kept it just kind of this perpetual motion type of deal. And will that last forever? No, it won't. But it has definitely been an advantage for the Bulls. And so while, yes, we can say, hey, we might see a similar action to Disney with the market when the deal is signed, it's one of those where, okay, when's that going to happen? Well, it could keep getting pushed off for many months here, and it doesn't have to happen even on the deadlines that are set and the deadlines that come and go. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.